Hello, I'm Rebecca, obviously, and I'm really sorry I can't be with you live today. I will be joining you for Q&A, I hope, so long as EasyJet lands me at Berlin Airport in time. But the great advantage of me doing it this way is that you can listen to what I have to say. You can stop recording or stop listening at any time that you want to, and fast forward through the boring bits. So I'm very much looking forward to taking questions shortly. And without further ado, let me roll into my presentation now. So I'm just going to share my screen. And I have called this presentation, as you can see, Omnicrisis, Geopolitical and Geoeconomic Megatrends. I'll just put it on slideshow so that you can see it properly. So why am I calling this omnicrisis? Well, if you read anything in the newspaper at the moment, you'd have the sense that we are surrounded by crises: a planetary crisis, social inequality, war, conflict, political crises all over the place, both in terms of domestic politics and international politics, but also that we're not quite sure whether or not we're out of the geoeconomic situation, whether or not we're going to see growth in the economy. Everywhere you look, there is bad news. And I've heard this called an omnicrisis or a polycrisis. So I thought, well, let's start off by cheering everyone up. But what have we learned since I last talked to you immediately after the invasion of Ukraine by Russia? What have we as a group of investors and what have investors themselves learned? Well, on the upside, I would say there may well be an end to the increasing interest rate cycle. So a lot of commentators saying that they think we've reached peak interest rates, and that from here on, because of the way in which economies are going, we might well see a reduction in interest rates during the course of 2024. In fact, some markets are already, and some analysts are already beginning to price in interest rate reductions towards the end of Q1, early Q2 next year. Now, I hope by the end of this presentation, you'll realise that I would be slightly more cautious about that. There aren't necessarily entirely good signs in the economy, and I hope to explain some of those. But The Economist in particular has argued that although we seem to be having roaring growth at the moment, particularly in the United States, actually we're masking a lot of other problems, in particular problems that are associated with the structural change with supply chain shortages and global trade. The other thing that we've also learned, or investors have learned, is that geopolitics appears to be baked in. What was interesting immediately after Russia invaded Ukraine was that markets reacted very badly. They dropped, oil prices shot through the roof, and we saw an immediate impact from that actually caused a lot of uncertainty. But it was amazing how quickly everything recovered. We've had uncertainty over the course of the last 18 months. We still have uncertainty in markets, but nevertheless, as I'll show later, the S&P has recovered by around 14% in the last year. So in actual fact, things have begun to establish a sense of new normality, slightly more volatile than they were pre-COVID, but nevertheless, the geopolitical elements of investing seem to have become something that is baked in rather than priced in. So we do see little fluctuations. We are seeing things that are making people nervous, but it seems to be interest rates that are causing the major fluctuations rather than geopolitics in and for itself. And we've seen that most recently because although there may have been some kind of an impact on oil prices of Israel's war against Hamas, we have actually not seen any major market impact from that that's been lasting. So in terms of what we've learned to live a little bit more perhaps with geopolitical uncertainty. And on an economic side, we're beginning to see perhaps the green shoots of recovery, even though the IMF is actually still relatively pessimistic about growth next year. On the downside, some other things that seem to have happened, technology and technology stocks seem to have lost their shine. There have been a lot of technology firms, particularly on the trade and trade finance side, that have struggled to gain money in order to get to Series B or Series C. That's been a reality of the last year. And ESG has lost its shine as well. So ESG investing appears to be something that has not managed to maintain the amount of sparkle that it had, say, 12 months ago. Now, there are reasons for that, which I will start to explore during the course of this presentation. But it's interesting that at a time when we are seeing major planetary problems, any technologies and any solutions that seem to be helping to mitigate some of that are actually less investable perhaps than they were a year ago. And that's obviously to the downside, but it's quite specific. So I guess the message of today is don't dismiss risk just yet. There's no sign around the world that political risk has diminished. We are still seeing the rise of great power conflict in the way that we were 18 months ago when I first spoke to you. We're seeing it in slightly different formats. We're seeing obviously a long and grueling war between Russia and Ukraine, and we are seeing a major risk of escalation in the Middle East. But the fact is that this is starting to become the new normal, and so markets are responding to it less. But it doesn't mean that if the war in the Middle East escalates, for example, we wouldn't see impacts on oil prices. And as I've just said, the IMF is actually predicting slower growth globally in 2024 and not a major recovery in 2025 either. Forecasts for global trade, for global output have all become more muted over the last few months. And the IMF's October report was actually quite downbeat. Now, the IMF is actually an organisation that quite often tends to forecast to the downside rather than the upside. But nevertheless, there are still very strong headwinds there. We've got potential deflation in China. We're still, although Chinese growth is likely to be way above 5%, it's recovered reasonably well. The longer term impact that it's having and the slowdown and changes in its economy and the risks in its property market are, of course, causing issues. One of the main sources of anxiety, I believe, is actually within the global trade system. Now, this time last year, 18 months ago, I would have said quite clearly that inflation is not something that can be dealt with through monetary policy alone. And the reason why is because a lot of that is coming from supply chains, coming from supply chain shortages, and coming from the fact that prices increase as soon as we get blockages and constrictions in those supply chains. Have we actually seen a diminution of those pressures? Well, there was an immediate shock immediately after we saw Russia invade Ukraine. There was a big increase in prices. So prices of oil and certain commodities went up by around 50% almost overnight. And in that month between March and April last year, they went up some prices even more than that. Those pressures have diminished slightly, but we still have major supply chain redistributions around the world going on. And there's a lot of argument to suggest that because countries and companies are beginning to look at relocating their supply chains in different countries or de-risking, so to say, their supply chains by getting their supplies from more than one supplier. What that means is it's all going to cost money. It all means new infrastructures. That's expensive. It's going to take a long time. And those pressures certainly haven't gone away. Another reason why I'm a little more sceptical about whether or not we've seen the end of the rate cycle is because of oil prices, of course, and oil prices are remaining high. They haven't gone down. They've gone down, but then they've gone back up again. Any potential for escalation in the Middle East, if Iran became involved, for example, or if it spread at all, we're likely to see more nervousness and uncertainty. We've already seen OPEC restrict its production for a little while to try and keep those prices high. So we can't assume that there is a major a major reduction or a permanent reduction in oil prices, or that oil prices aren't going to react to the problems in the Middle East. Other risks that are coming down the line, and this next point relates particularly to the regulatory structure. During the course of 2023, I think we all had laid bare to us exactly how severe climate change was likely to be, and how that would lend a different way of lifestyle, require a major amount of adaptation to those new lifestyles. We had 5 heat dome events in 2023. Now, a heat dome is when you have almost like a vacuum of air that builds from heat from the ocean that goes over a country, and when the air currents pick up the heat from the ocean and then take it and it stays over a country. And we've had 5 of those during the course of 2023, causing the heat waves that we saw during the summer, and fires and flooding. Everyone is suddenly much more aware of the fact that climate change and extreme weather events, they're not the same thing. Climate change is a real thing. These extreme weather events are also a real thing. Now, what does that mean in terms of adaptation? It also means we're having to think about different ways of doing things, different ways of producing, different ways of organising our supply chains. And so the fact that there is a climate crisis which is pending, and we feel it, and an energy crisis, we feel it more in Europe maybe than in some other parts of the world, because it's also affected prices. But even so, the events are beginning to make it clear to the rest of the world as well that we need to think about doing things differently. That will have an inflationary impact. So don't dismiss that inflationary element as the need for adaptation becomes more significant. And then the final thing that I've listed here as a kind of risk in the near term is actually the election in the US in 2024, which could really create some uncertainty in the coming 12 months, because we don't know what the outcome of that election is going to be. At the moment, we look like there's a very strong possibility of a Republican president in Donald Trump. The return of Donald Trump tends to make people very nervous, but perversely might actually have a positive impact on markets for a short time. We don't know at the moment. It's impossible to scale that, but what we are going to see is a lot of political uncertainty around the role of the US, the debt ceiling, whether or not the US is still able to maintain its economic hegemony around the world. That's something that is deeply concerning to markets, because if the US is actually the world's global policeman, lending that degree of economic stability through its support to the US dollar, through allowing the debt ceiling to be raised, then it says that the US is there, it's a constant, and it will keep markets stable. As soon as there is any uncertainty around that, we might see some volatility, and that's something that might in turn create risks that we're not foreseeing at the moment. And just a basic message, which I will come back to, which is risks, relatively small risks, can escalate in the current climate at the moment relatively quickly. So it's this unexpected nature of change which is going to be most significant, I feel. So why is all of this happening? I'm going to give you a quote here, which came from the World Trade Report from the World Trade Organization in September this year. And the World Trade Organization was set up, as it argues itself, because it felt that fostering interdependence amongst economies would play a crucial role in achieving peace and prosperity. And what the report goes on to argue is that, and I quote, recent crises such as COVID-19 pandemic and the war in Ukraine have fed into perceptions that globalization exposes economy to excessive risks. Consequently, a trade skeptic narrative has gained traction, suggesting that international trade is an obstacle to building a more secure, inclusive, and sustainable world. In other words, in some senses, what the World Trade Organization itself is doing is putting globalization and international trade in the dock. And a lot of the reason for that is because the way in which we're running our defence and security at the moment, the way in which we're managing our reaction to the COVID pandemic, the way in which we're adjusting supply chains has become deeply nationalistic, and it's all feeding through international trade. So where should investors be looking at the moment? To a very large extent, trade, which is a hidden thing to very many investors. Trade is actually a bellwether for everything else that is happening in the economy. The World Trade Organization has pretty much put it on trial. So what do I want to do through this whole talk? I'd like to explain what's going on. I'd like to explain the interdependencies and their consequences. I'd then like to interpret what's going on so that you've got an idea of what my view is and what the data is telling us about things like the use of sanctions, things like how international trade and how international trade is feeding through into an inflationary framework as well. And then at the end, make a couple of observations, recommendations about how all of this plays into the things that you, as advisors to investors, need to be aware of. Let's start with looking at the types of change that we face. We live in a world of constant change. Now, change is something that goes back forever. Change is endemic to economic systems, it's endemic to social systems and political systems. But what we have at the moment is a type of change which is actually rooted in the whole way in which we work, way in which we relax, way in which we do business, the technologies we use, the future of our planet, the way we fight wars. This is why I am calling the situation or the environment that we're operating in at the moment the omnicrisis. Let's have a think about the way we work and relax. For example, we relax with our screens in front of us, and we also work with our screens in front of us. Technology is at the heart of all of the changes that we're seeing at the moment. So if you think about it, you don't operate in the same way. You have your phone with you all the time. You communicate with people. You shop in different ways. Everything that you do is around technology, and that is getting more and more and more advanced. We're going to see AI come into our lives. AI, big investment bubble at the moment, but we've also seen some really substantial barriers to that in the future in terms of the need to have regulation, the actors strike in the United States. All of these things are we're beginning to be aware of both the risks and the benefits. But there is little doubt we have changed the way we work and the way we relax since the COVID pandemic in particular, and it's accelerated a lot of the digital things that we have started as digital technology changes that we've started to see. The way we do business, the way our supply chains work, the way we interact in business, the way we use e-commerce, all of that, again, a lot of it is driven not just by a geopolitical framework that says we can't work with Russia and we don't want to work as much as we have done with China because of the risks that China might use the technology that we have for military purposes. It's not just the geopolitics, it's actually the way in which we organise production, the way in which we organise people, the way in which technology has started to take jobs and use the way in which we're using things like artificial intelligence and the Internet of Things to organise our working lives, the way in which we now use 3D printing to a greater extent than we ever did, and so on. So the way we do business is changing as well. We work from home. We operate in different ways in terms of email, in terms of Zoom. Everything we do is different. And a lot of that, as I've already said, is based on the technology that we're using when we have access to this massive shift in the way we are operating that isn't just an economic shift, it's not just a technological shift, it's not just a financial shift, it's affecting the way in which we do everything. So it's almost paradigmatic. It's changing the way in which society operates. And of course, we have to change because the future of our planet depends a lot on the way in which we're organising our energy supplies and our energy resources. Technology might be a way of solving some of those problems. It might also be a way of adding to some of those problems. And so we've got a lot of uncertainty in terms of how to make our world sustainable as well. And it's obvious in the war that's being fought in Ukraine at the moment that we have battles being fought in very different ways. The use of drones, for example, the use of commercial drones rather than military drones, who were very influential in blowing up the convoy of tanks right at the beginning of the conflict. So it's incredible that we are now using artificial intelligence, and we're using machine learning, and we're using different types of technology to fight wars. All of this is altering the way in which we do things. To some extent, we're frightened of it. We're seeing conflicts coming as a result of it. And this is what gives us the perception of the omnicrisis. But one thing really struck me was how much this is actually altering the economy as well. And this might be something that creates a market bubble, if not a market trend, in the coming months or even years. And this is something called the hermit economy. It's you and me working from home, consuming at home, buying stuff on Amazon, or having food delivered to our doors. All of this is worth $600 billion in 2022. We haven't got an estimate of it for 2023 yet, but there's every chance that it would have increased. We're looking at buying goods to look good and feel great without going out. We're staying at home. We aren't eating as much in restaurants. And some of this is, and this is in the US and the UK and Europe. It's not just the UK, it's beyond. Why are we doing this? It isn't just because we've got used to not going out. It's partly legacy pandemic, and organisations like The Economist say it is legacy pandemic. Our behaviours have changed permanently, but it's also because we can rely more on digital services. It's because e-commerce allows us to shop efficiently, but it's also because prices are rising and it's cheaper for us to stay at home than it is to go out. So to some extent, this hermit economy is reflecting the technology, it's reflecting the societal changes that we're seeing, but it's also affecting the economic conditions that we're in at the moment. So if I just summarize all of that and say that I think there are really 4 big megatrends which are having an impact on markets right now. I'll leave it to you to decide which ones you think are the most important and which ones have the biggest impact on markets, but they're nevertheless the things that investors need to be very aware of and very conscious of when they're making investments. So the first bundle of stuff is geopolitics. Russia-Ukraine looks like it's a war of attrition now, looks like it's gone into, from that initial thing which was about might we see a nuclear war in Europe. At the moment it's relatively stabilised, but it's become attritional. Is the Ukraine capable of winning? Is Russia capable of winning? What might happen? What might the end game there be? It's looking like people are beginning to think, and policymakers are beginning to think, about the economic solutions to all of this and how to rebuild Ukraine, rather than actually limiting that conflict. And to some extent, a stasis in that conflict suits both the US and the allies, because it means that it's not escalating a conflict, it's keeping Russia confined to its conflict in Ukraine and not necessarily thinking about the Baltics as an alternative. That's an oversimplification, but we now know to some extent it's a known unknown. The Middle East is less of a known unknown, it's more of an unknown unknown, because we're at the beginning of a perennial conflict, one that's been there for a very, very long time. The Middle Eastern conflict, the major risk for global markets is twofold. The first is if it escalates and actually creates problems for the oil price. And the second is if it escalates and creates geopolitical uncertainty and the threat of actual war involving more than just a regional conflict. There is involvement of Russia in some of this. There is involvement of the United States. Obviously, there are ships that have been moved to the Mediterranean in order to control the conflict. But the main problem for markets are those two elements of uncertainty that are there. Will it escalate, or will it have an impact on the oil price? At the moment, the jury's out on both. So we've not seen a major hike in oil prices. In fact, Saudi Arabia and OPEC nations are beginning to restrict production in order to keep oil prices high. But the risk of escalation, and this is a regional conflict and it's extremely complicated, the risk of escalation is always there. And while Iran came out during the course of last week and said that they weren't looking to escalate the conflict, for as long as there is fighting going on in Gaza, that is a very real possibility. And we don't know how that's going to pan out, so markets will be nervous about where that goes, but seem to be taking it in their stride as things are at the minute. Then the rise of great power conflict. Great power conflicts we've always seen in terms of Russia and the United States. Obviously now we're seeing a multipolar world, and the risk that China starts to use technologies and so on to build its own military and move into Taiwan is one that is a very real prospect as well. American generals are saying that they think China will have the capability to move into Taiwan by 2027. China is saying, back off, this isn't something that we're actually considering. And I think this is where it feeds into the general economic framework, because the rise of China is absolutely a reaction to its entrance into the multilateral trading system. China's foreign policy has always been one of expansion and influence through its economic power rather than its military power. It sees war and peace as being able to coexist, and its influence that it's extending at the moment through Belt and Road and through its control, for example, of lithium, and I'll show you some numbers on that shortly, has actually been very significant. So in actual fact, where's China's rise? Where is the great power conflict? It's geoeconomic rather than geopolitical. It's actually, from an economic point of view, doesn't make sense for China to invade Taiwan. But the rise of China is something that the Americans are very nervous about because it threatens US dollar hegemony. It is something that threatens the role of the US dollar in the global trade system. And what that does is it means that we are considering as a world relocating supply chains, de-risking globalization, if you like, creating a China plus one strategy so that we're not utterly dependent on either China or Russia for the supplies respectively of semiconductors and rare earth metals and fossil fuels. And all of this is creating an economic uncertainty, which then, to go back to the top point, is, are we going to go into a recession or are we going to have a soft landing? At the moment, the smart money appears to be on a soft landing, but we're not out of the economic woods yet, as I said, for the very simple reason that we are still seeing a lot of inflationary pressures coming through the trade system. We are still seeing major adjustments in supply chains that to some extent are a reaction to the use of sanctions as well. And then you've got a whole load of technology trends that are happening that are altering the way in which we do things. So crypto and the payment system, in that you could include central bank digital currencies. These are all different ways of monitoring people, controlling data, and also altering the way in which we pay for our goods and services. Might we end up with one world, two digital systems? There is a risk as a result of the Russia-Ukraine crisis and the rise of China that we're beginning to see a digital framework which does include digital central bank currencies, central bank digital currencies. We're beginning to see one world and two digital systems emerge, which aligns to some extent with the difference between autocratic regimes and democratic regimes. So there's a lot that's happening through technology which is calling our own identity as democracies into question. And then the Internet of Things and AI, is it an opportunity or is it a threat? That's something that we need to decide as a world. Internet of Things connects everything, which then means artificial intelligence and generative AI can start to do things that human beings have done in the past. It is a huge threat to jobs, but it might also represent an opportunity to jobs and new worlds and new things that we can create. The role of regulation in all of this becomes very important, which then leads into the sustainability question, because this is one of the big mega trends which is beginning to have an impact on markets as well. There's been a huge amount of asset money tipping into sustainability investments and markets. Those markets are now becoming increasingly regulated. The investment market is regulated. We've also seen a big change in the political attitudes towards sustainability. And again, that's one of the themes that I'll pick up shortly. But a lot of this is about consumer behaviours and how consumer behaviours are changing, because if we're seeing more hermits in our economy, then that might well mean that we have a more sustainable world that's beginning to develop, because people aren't consuming things in the way that they used to. But what's really interesting is that those people are consuming goods rather than services, so that in actual fact, you still need stuff to be delivered. You still have that fossil fuel dependency, which is of course affecting supply chains. And then we also need to worry and wonder about whether or not we're more worried about environment, social or governance issues within that whole sustainability framework. These will all be things that become very important in discussing with clients and talking to markets in the coming months and years. So let's start then, and I know that's a lot of material, but that's basically summarised my argument. Let's start with looking at global trade on trial. Let's have a think about why the World Trade Organization itself put global trade on trial, what it was trying to say about where we've got to with globalization. And it's all about this de-risking, deglobalization and trade fragmentation, which has come about because of COVID, because of nationalism, economic nationalism, protectionism, and obviously the need to use sanctions and export controls to limit Russia's power. And what's happened here is that trade has become very embroiled in national strategy, national security strategy as well. So what's happened is that trade isn't just about economic benefits anymore. And that's what the World Trade Organization is highlighting as a problem. So here's what the World Trade Organization thinks. We should re-globalize. We should become more integrated as a world, not less integrated as a world. And they argue that trade has been growing, so there's no evidence of deglobalization, that the multilateral trading system creates a more secure, affluent and sustainable world through interdependent global value chains for everyone. So they're seeing this interconnectivity as actually something, rather than it being weaponized, they're seeing this as something which is beneficial to everybody. Because we're interdependent, we are less likely to have wars with one another. And they argue as well that economic nationalism and protectionism are barriers to the benefits of international trade. So if we all become nationalistic and protect our own backs in economic terms and trade terms, then we're actually hiding ourselves from the benefits of international trade, which is benefits for everyone, not individual nations. And they also argue that without a multilateral global approach to climate change, we can't solve the problems of climate change. So this is something that we have to do together. And I don't think there are many people who would disagree with that. And that's certainly something that Presidents Biden and Xi were talking about during the course of their meeting last week. And then the final thing is that they say economic rivalry actually damages the economy and creates net GDP losses, which has a particularly severe impact on emerging economies. So if we are fighting a conflict with China, an economic conflict with China, then China's supply chains are no longer accessible. That actually undermines emerging economies in emerging Asia and emerging Africa, and it hurts them more than it hurts the large economies. So we should become more integrated. We should do more to work together. Now, if you look at what's actually been going on and the reason why there is all of this debate about whether or not trade is actually to an economic benefit and whether globalization is to our economic benefit, we've got a situation where we're looking more at the realpolitik in terms of a fragmented world. And if you like, the prosecution would argue globalization has created inequalities and a sense of haves and have-nots. That's true. The basis of the populist anti-global movement is that there are countries that have more than others, there are people who have more than others, and that means that jobs are being taken away, they're being put in parts of the world where they're not creating equal opportunities, and that has led to some countries, and here we think mostly of China, behaving unfairly, and in that they've taken advantage of the rules-based multilateral order, which has disadvantaged manufacturing and jobs, especially in advanced nations. And that was behind the whole principle of Trumpian economics, and actually to some extent Biden's economics as well, bringing jobs back to the United States. Globalization, they also argue, has created dependencies on single countries which are unsustainable. So all of this needs de-risking, and that's what we're seeing in terms of critical earth metals and our dependency on Chinese supply chains. And then advanced technologies used in military applications can be acquired by adversaries. So suddenly we're using a language of conflict. We're talking about adversaries. We're talking about Russia and China as adversaries in this context, and saying they can get hold of our technology because of globalization, which they can then use in military technologies. This has been evolving for a long time, don't forget. It's not a new story that's just happened in 2 or 3 years. This is something that has been happening for a long time. And then from the flip side, emerging economies and the developing world argue that dollar hegemony and Western-centric rules are actually disadvantageous to emerging economies. So it's an equal but opposite problem on the other side, and that is creating countries that are neither aligned with Russia nor aligned, and China, nor aligned with the dollar hegemonic framework, a Western framework. They are aligned to whoever will create their own economic advantages. And this is why you've seen the rise of the BRICS nations, why you're seeing Africa and India so vocal at the moment about the lack of fairness of the current global system. And what's behind all of this? It's because technology has allowed us and allowed the whole world, quite rightly, to have access to resources. So it is both a geopolitical and a geoeconomic problem. Now, I'm going to throw a few numbers at you. These are some charts that actually prove a lot of what I've been saying. If you look at this one, global trade is illustrating the origins of inflation. Now, I've deliberately taken this back here to 2014, the beginning of 2014, because you can see quite clearly what happened during that whole period, both in terms of the initial Russian invasion of Ukraine, but then also annexation of Crimea, but then also what happened during the COVID pandemic, which is this big drop here, and then what has happened since. Now, if I take a look at this, has global trade increased, as the World Trade Organization says? Absolutely. In volume terms, it's gone up marginally from just around 17.5 trillion dollars to here, where we're looking at a value of just over 21 trillion US dollars, which is the value of trade in volume terms. So we have seen an increase. But on the other side, you can also see here, since the COVID pandemic, where inflationary pressures through supply chain blockages, this is 2021, the beginning of 2021, you can see that created inflationary pressures. Then you can see where trade has actually dropped back because of uncertainties immediately after Russia invaded Ukraine. And then you can see here, very interestingly, where price changes actually outstripped the increase in volumes. So that in those 2 points there, particularly driven by oil prices and food prices, you could see that they were creating inflationary pressures. Now, of course, these are different in different regions. So you can see here that this increase where the increase in values was higher than volumes has been particularly severe in advanced economies, whereas in emerging economies, what you're seeing is volumes increasing actually relatively sharply post-pandemic, which is something that suggests that there has been more happening in emerging economies, that they have recovered more quickly. But you can also see here that prices have gone up very sharply as well. So that leads us into a question. Can we use trade as a way of constraining Russia or China? We've already seen that the tension that it creates economically is inflation. So if that creates inflation in the West, in domestic economies, and the burden for those economies is great, then is there any sense in using weaponized trade, in other words, sanctions and export controls, to constrain Russia or even China? And this is a big question in the aftermath of the presentation that I gave last year, when we were saying, well, we've got to use sanctions because we can't use military means. So we've got to use sanctions and we've got to use economic means. And this chart tells us quite clearly what's happened. If you look at import values since the COVID pandemic, actually the COVID pandemic here, this goes up to the end of 2022. You can see here that COVID caused a large increase in Russian trade after everyone started recovering in value terms. And a lot of that was to do with oil and gas prices. You can see here that imports have fallen in value terms in Russia since the invasion. And you can see here as well that there's a big drop in the immediate aftermath of the invasion, but actually trade revenues are beginning to creep up again. And this, in terms of export revenues, this is actually something that the West is trying to avoid. So you can see here, slight recovery back to even pre-COVID. We're beyond that now. We're beginning to see values of Russian trade actually increase. Now, we've used sanctions and export controls on an unprecedented scale to constrain Russia. We were not deliberately trying to squash its economy. That's a side effect and would have handed propaganda victory to Russia anyway. But what we are doing is trying to constrain access to oil revenues through the embargoes and the price cap, access to technologies, and access to luxury and foreign currencies, in a way, very simply, to stop it from being able to fund its military exercises and its military activities in Ukraine. The effects have been relatively muted. If you look at macroeconomic statistics published by the IMF, it looks like Russia grew at 2.1%. Well, the UK economy grew at less than that. So obviously invading a country has less of an effect than leaving the European Union. But it's nevertheless, the effects have been surprisingly muted. Now, on the ground, there are shortages. In Russia, the Russians don't like sanctions at all, but the effects on trade in value terms here are not as severe as the effects on trade were if you look after the post 2014 annexation of Crimea. So the other thing is that we've diverted trade. So if you look at the major destinations for Russian oil, China and India, if you look at these thick lines, this thick line here is China. Immediately after the invasion, China took a huge amount of Russian oil, massive amount of Russian oil. It's fallen back since, but you can see here that, and the data series ends because China isn't great at reporting its data, but you can see just how much oil China did take from Russia in the immediate aftermath. You can also see as well that India has become a very powerful ally of Russia in terms of importing, and that its oil trade has not fallen back. So again, you've got the same pattern. These are different axes, but India and Russia are the major players here. Big increase again over a longer period of time. You can also see that trade has carried on increasing after the price cap as well, so that you've got a very significant role for India and China. Now, the other two that are interesting are Turkey, and this is Turkey. You can see its trade, oil imports from Russia have escalated. They've gone up a huge amount since the invasion, and Turkey is obviously one of the major diversion routes that's being used. And Bulgaria is quite interesting because immediately before the invasion, Bulgaria's trade was increasing. It dropped off because it had to drop off relatively quickly, and although it's fallen back, this is Bulgaria, although it increased just before the invasion here, and although it increased a little bit in the immediate aftermath, because it's had to comply with sanctions more, and it's been more constrained by its membership of the European Union, it's fallen back, although you can see there's a little blip there as well. India is now the biggest oil importer of Russian oil, and that's increased. And you can see that the UK, for example, has been buying Indian oil. It's put into barrels. It might well and put on third-party, combined with third-party ships. And what that might actually mean is that we are indirectly consuming Russian oil, but buying it through India. Middle East has also benefited. You can see here most of Middle Eastern trade with and Central Asian trade with Russia is in oil, also in commodities not elsewhere specified and areas not elsewhere specified. These are countries and trade routes and products which are undefined, but they're very closely related to oil and gas. And Russia has increased its areas not elsewhere specified trade. It's also increased its commodities not elsewhere specified trade. And you can see that since March 2022, both exports and imports for the Middle East and its trade with Russia has increased. And I'd say, as an investment community, look out for gold, because one of the interesting things about gold is that it has become the default way that Russia has been using to circumvent sanctions, and the UK is a good example here. Now these are thick lines and they're not very pretty, but if you look here, this is UK's trade in gold with Russia just before the invasion of Ukraine. This is Kazakhstan. Russia's trade in gold drops immediately, but as soon as you look at the gold trade with the UK from Kazakhstan, you can see here it shot up and it stayed up. This is where there's no data available. So actually you're seeing something happen with gold that is very interesting indeed. And the UK isn't entirely guiltless, if you'll pardon the pun, in this respect. Now, another thing that's been going on is that China has had its access to technologies limited. And this is interesting because if you look from 2011, from trade between China and the US in semiconductors, has been falling back anyway since 2014. So a lot of this is US imports from China have been falling back, and they fell back until 2019. But actually, if you look, they've remained relatively high through 2020, so they've actually stabilized. If you look at US exports to China, in terms of limiting the amount that goes on, it's only in 2022 where we started to see a restriction. Trade was already falling back after 2014, and in fact, since 2016, it's increased slightly. So again, that's something that we need to be aware of, that restricting trade with China isn't necessarily stopping trade with China. It hasn't necessarily had that impact. And I want to dwell for a moment on sustainable investment and growth, because the reality here is politics. Sustainability is something I wanted to talk about. We've seen ETFs like the Invesco Wilder Hill ETF go down by 32% over the last 12 months, while the S&P has gone up by 14%. Assets under management, estimates from Bloomberg, increased by 53 trillion by 2025. but flows into assets under management have actually been slowing. So although we're still seeing them grow, that growth has been slowing down. And let's have a look at why when you're talking to when you're talking to your clients. Reason is that we have huge regulatory constraints, and we also have political backlash. So regulatory constraints, everybody is having to report, larger organisations and larger financial organisations having to report on their sustainability exposure and their climate-related financial risk. This is to avoid greenwashing, but what it's doing is it's meaning that we're actually green hushing. We're taking a lot of the things that we were doing out, and we're complying at a minimum level. And I did some research on this. Happy to take questions on that afterwards. But the political backlash is actually quite serious. We're seeing investors and we're seeing politicians actually say this is something that we shouldn't be doing. It's becoming too constrained. The regulations are too constrained, and we still need big oil because otherwise it's inflationary. And there's some kind of a big backlash against sustainability investing. It's almost the California versus Texas argument, but that big backlash is real, and that's going to underpin investment in these investments in these asset classes will be affected by the outcome of the US general presidential election. And we have a huge dependency on China here. So Vietnam, for example, produces ore, but it doesn't produce refined products. China has 60% of production and 85% of processing capability when we're looking at ore exports, so lithium or rare earth elements. And if you then take that into how the rate of change is working, you can see that other countries around the world, particularly Hungary, Germany and Poland, their growth is very, very high. If you just look at the fastest growing economies, but China already controls the majority of the market, and look how fast it's growing even so. So if you look between 2017 and 2021, its growth was over 30%. You'll still look at it on a year-on-year basis. So you're looking at massive growth. Other countries come from a much smaller base, and although they're growing quickly, they're not going to be able to catch up China anytime soon. So this is an exposure that we will have. And sustainability is more than climate as well. It's also, as I said at the beginning, about the social aspects. China's accelerated its exports since 2010 relative to production. So you can see that actually its production-weighted exports are good. That means that suggests that it's creating jobs. But if you look at Latin America, you look at Africa and the Middle East, actually they're below 100%. So they are not creating jobs in relation to exports, and that is a concern. You could say Japan and the UK aren't either. They're also below that level, but a lot of that is because supply chains have shifted around, and so the reasons are very, very different. Global inequality is also growing. So in terms of what the World Trade Organization thinks and the backlash against globalization, we're still seeing inequality grow. And the focus on environmental change and environmental trade could actually mean that we're excluding a lot of countries that need to catch up in equality terms. And this is, again, the reason why particularly emerging Asia and Africa are concerned about the regulations coming through, because if a bank or an investor can't invest in a tier 3 or 4 supply chain that's based in Africa because the data isn't there, that's obviously going to restrict access to trade finance and restrict the extent to which they can partake in a more sustainable trade-based system, ironically. So then there's climate change itself. Only $1 in every 5 in international trade contributes positively to sustainable development goals. And there is an extent to which, as we've seen recently, sustainability has become a lever in great power conflict. The Arctic Ocean, for example, is somewhere where we're beginning to watch very closely because there is Russian actually supremacy in the Arctic Ocean, and it's beginning to use the Arctic Ocean as a means to furthering its own influence to create trade routes through. So it's becoming a lever in that great power conflict as well. Lots of close relationships between China and Russia in terms of developing those trade routes in the long term. And so it might start to become a security issue: food, migration, climate change, climate-related migration, all becoming security problems that a lot of policymakers are beginning to be more concerned about. And what's of more concern in the end, great power conflict or the survival of the human race? So as an advisor, what do I need to know? Economically, is it all too good to be true? I would be having conversations that would suggest that inflation may fall, but we've still got very muted global growth forecasts for all the reasons that I've talked about. There is inherent insecurity there. Sourcing from and selling to into some markets will get more complicated. We've got this de-risking and decoupling. We've got grain and oilseed food supplies being weaponized in the Black Sea. It's creating challenges, and we're beginning to see a lot of those which might spill into the Mediterranean and into the Middle East as well. And then sustainability is directly impacting on supply chains. We've got regulations, supply chain acts, which are political, the Inflation Reduction Act, which is also redistributing a lot of the technology supply chains and sustainability supply chains to the United States. So that geopolitics is changing geoeconomics. These are the big things that we need to be thinking about and talking about, just in summary. So here you go. This is how they're all interdependent. Trade has been used over the past 18 months as a tool of constraining an adversary rather than fighting with them. Geopolitics, Russia's discontent with the global trading system has created its general approach to its loss of empire. We're using trade, and then we're also using trade as a means of deterrence by denial in terms of technology and our approach to sustainability. And then banging against that, you've got geoeconomics, China's reach and influence through trade, and its coercive influence through trade as well. And above and beyond everything else that we've learned over the last 18 months is that small things can escalate and upset markets very, very quickly. The world is unpredictable, and it's also very dangerous at the moment. If you talk to security professionals, they are saying we are very, very close to a very worrying situation. So whatever happens, don't write out risk entirely. Thank you very much for listening, and I'd be happy to take any questions.